Hi there, thank you so much for checking in. In this video, we're going to be talking about the bid and the ask on an option chain and how they relate to you when you're placing an order. So let's go ahead and get started by talking about the bid and the ask. Here we've pulled up Tesla's option chain. We're about 3 weeks out. It doesn't really matter the expiration date for you. What we're focused on here specifically are going to be the bid and the ask. And no matter what broker platform you're using, you're going to be able to find the bid and the ask, whether that's for a stock or whether for it's an option chain. So for example, for Tesla stock, you can see there's a B and an A here. The bid is currently 241.16 and the ask is currently 241.17. And then on option chains, you can see there's a bid and the ask, and it varies on different contracts, whether you're on calls or puts, and as you go up or down the strikes. So what are the bid and the ask? They are the people that are going back and forth and pretty much auctioning off that contract back and forth to each other. And the more volume there is, so the more people auctioning this contract back and forth with each other, the tighter the spread between the bid and the ask are going to be. So now the question is, what is a spread? Let's take, for example, Tesla's 300 contract, where you can see that the bid is currently 1.25 and the sell is currently 1.29. So there's a $4 difference between these two because the bid is currently $125 and the ask is currently $129. So there's a $4 difference between those two, and that difference is something that we call the spread. The tighter that spread is, the more liquidity there is in that option contract. Liquidity is how fast you can get in and out of that contract at your desired price. Now, Tesla is a very active stock and it currently has a ton of volume, which means that it's going to be fairly easy to get in and out of contracts very quickly at your desired price. You may not get your price, the price that you want, by a dollar or two, but it's not that dramatic of a difference because the spread here is a tight spread. Now, if we could compare Tesla to something like Costco, for example, which trades at very low volume levels. So Costco is not the most popular stock to trade. Therefore, the spread on Costco's contract is going to be much larger. Let's take the something comparable in price. Let's take the 935 call on Costco, where you can see that here the bid is 1.24 and the ask is 1.57. So that's going to be about a $30 difference between what the buyers are looking to buy for and what the sellers are looking to sell for. So here the buyers are bidding to buy at 1.24, saying this is the max amount that I'm willing to pay for this. And the sellers are saying the least amount I'm willing to take is going to be 1.57. Now, of course, it is after market hours. These numbers are constantly changing throughout the day as the stock goes up and down. But for the most part, you can see that there's a battle between the two, and they're both trying to get filled at a specific price. Now, getting filled is going to take us into our next portion of this video, which is going to be what limit buys are versus market orders. So for example, say I do want to buy this contract, and so I click buy, and if this pulls up down here, you can see I have one contract selected. Now you can see that automatically my broker, which is Thinkorswim, tries to fill me at 157. Now remember, we're trying to buy because we're buying. We're making money when we're buying. So we're buying here. We want to get in as close to the bid price as possible. And my broker is already trying to get me filled at 157. So that means if I get filled at 157, I wouldn't even be able to sell it back to the market at a desired price. I would already open up in the negative. And a lot of you face this. A lot of you young traders are going to face this. You're going to buy a contract and it opens up negative. You're already down 10% for some reason. And here in this case, this is exactly the reasons, because your broker, especially brokers like Robinhood or any broker, are going to try to fill you in at a higher rate, and then they pocket the difference. So they buy the cheaper contract, they fill you in on the more expensive one, and they pocket the difference. So smart traders, here's what you got to do. You got to make sure you're on a limit order. limit order, not market order. The market order is going to fill you at the next best available price, no matter what it is. It could be $2. If that's what it fills you in, that's what it fills you in. So when you're buying or selling, you want to be on the limit order, and you're going to try to fill in as close to the bid price as possible. So here in this case, I'm going to be changing this to 1.25, and I would confirm and send this. Now, if I don't get filled, I may have gotten too audacious with my bid. It's going to be very difficult to get filled at the bottom end of the spread. And so you want to go somewhere in the middle. Say it's 125 to 157. You want to try to shoot your shot maybe at 135 and see if you get filled. If you don't get filled, maybe raise it to 136 and continue doing that until you try to get filled as close to the bid as possible. That is going to be applied vice versa when you're selling. So say, for example, it's time to get out. You've already been in this and you're selling. When you're selling the contract, you want to try to get filled as close to the ask as possible. So as close to 157 as possible, because you're trying to get filled at the highest price. That way you can maximize your profit. And so that pretty much leaves us with the end of the explanation for the bid and the ask. But we're going to compare this back to Tesla just to show you just to go back to the initial example. And so with Tesla, notice the spread is a lot tighter. So my broker is already going to try to fill me in at the top of the spread, but maybe I can just bring it down 2 notches and try to get filled right in the middle between 125 and 129. I try to get filled at 127 and confirm and send my order and see if it fills. And so the reason why that's so important, you guys, is because you are battling other people on the market and you're constantly trying to make any dollar that you can, especially as a short-term trader. So you're trying to maximize the best entry and the best exit. And when you do so, you have to do it via a limit order. When you're doing a market order, notice that this even disappears because I don't even have a choice. I'm telling them, hey, fill me in at whatever it fills me in. And that's so dangerous with options, because what if it buys it for you at 150 and it's right now at 125? You're already down $25. And so that's why you have to take what's yours. And so you have to do limit orders. You want to try to get filled closer to the bid when you're buying and sell closer to the ask when you're selling. That way you don't open up negative and you don't lose money unnecessarily.